The broadcast is now starting. All attendees are in listen-only mode.
Okay, everyone. Good morning or good afternoon where you're at. This is Haru. I just want to cover candlesticks today. And I'm pretty sure you heard the phrase candlesticks, and we're going to cover kind of the ideas of why candlesticks are still used today. Now, you may understand that they've been discovered back in the 1800s. That's a long time ago, right? So, as you know, Mr. Homa was the actual individual that discovered candlesticks, and that's the thing. We use candlesticks in the financial markets, and if they're still being used today, this is in the 1800s, guys. So if that means we're using them today, we're probably projecting to use them for the next 200 years or so. They've been around for a long time. So they were actually used to count rice, and now they're actually patterns and reading these candlesticks and what they say to us. So it's pretty much a body language, and I'm going to walk you through some ideas behind candlesticks and how they're used in the financial markets. So number one, here we're on the H1 chart. Okay, so this is 1 hour of data. We just barely started this candlestick within just 2 minutes. Okay, so there's a candlestick right here, which was an hour ago, and 1 hour of data, 1 hour of data. So you can see that this market rose all the way up to this top here and pulled back down, and then it closed as a white candlestick. Okay, so these candlesticks that we can see here, this is the hour chart here, is what activity happened within what just happened recently. Okay, this is within the day or so. Now, there's different time frames, and there's obviously some people have different preferences as far as what time frame fits their trading methodologies. I'm just going to kind of walk you through the idea behind this time frames. Okay, so if we kick up to the day chart, we're going to take 24 of these candlesticks and we're going to squeeze them together to come up with that one-day candle. Okay, you can see I'm going to get rid of this line here so you can see here. This is what's happening within the day. Okay, we still have about 8 hours before this candlestick actually closes my time. So 8 more hours, then this candlestick will close. But you can see each day represents 24 of those 1 hour candlesticks. Okay, so if you look at it in a daily standpoint, we're actually rising upwards. Okay, we were trending downwards for quite some time now. Okay, so we had a huge trend downwards, and now we're seeing some bull moves, and we're working our way back up. Okay, that's how I look at this market right now. So we kick back down to the 1 hour chart. Okay, so it's a different point of view. Okay, we have this dip, and really on a smaller time frame, we're actually more interested to buy these dips. Okay, where we can actually buy the dip and look for the market to rise upwards. Buy these valleys is what they're considered as. Okay, if we actually go to the 1 minute chart, what we're doing is we're taking this one candlestick and we're breaking it down 60 times. Okay, so there's 60 minutes in 1 hour. Okay, so if we go to 1 minute, okay, so I'm just going to go over here. So you can see within that 60 minutes, this is what happened. Okay, so your point of view, you have to consider your spreads. Okay, our point of view is really small. Okay, so if we look at 60 of these candlesticks, we're really only looking at this one bar here, guys, just this one little candlestick. So really, the reality is if you're on the 1 minute chart, you're making your decision on just this amount of data. You're not really projecting with all this information right here. Okay, so that's the difference between time frames. Some people do like the smaller time frames. It's really fast, so you have to react quicker. But the thing is, if you think about it, is really you have to think the exact opposite of other time frames. Okay, so if someone's a swing trader and they're looking at the day chart to place big trades, so looking at this scenario as a buy position, I'm really on a smaller time frame. I'm looking for this pullback. Okay, and then looking the exact opposite. So here on the day chart, let's actually thinking about in a hindsight perspective like this. Okay. Really, this day chart looks like it's climbing upwards, but really I'm looking for the exact opposite of the day chart traders. Okay, and then vice versa on the 1 hour charts, you have to think the exact opposite. Okay, because if you look at the 1 hour chart again, okay, let's go back here so you can see this. Really, this is what's happening within the day. It's pulling backwards. On the day chart, it looks different. The point of view is different, and then here we raise up really quickly within just a few hours. Okay, so swing traders, they stay in trades for quite some time, a couple days or even several weeks. More of the day traders are going to be looking to trade within just a day or two. Okay, maybe they're only going to be in from this point to this point, back to resistance. Okay, so these candlesticks really are just like a body language to us. It's basically, if you read them, they can kind of show you the intensity of what the market's doing. So here, this long wick here was either based on economics. There was a lot of volume that came in the market that spiked it up and then pulled it back down. Okay, so I kind of feel bad for those traders that were looking at a very small time frame. Okay, I'm just going to show you like this, just to give you an example here. I'm going to draw this little red line here so you can see which candlestick I'm looking at. And the wick went all the way up to here. Okay, so I just want to show you the point of view I'm presenting to you guys so you get a better idea here, and looking at a hindsight perspective. Okay, so people thought, okay, it's buying, buying, buying. This is kind of like the smaller time frame individuals here. And so here we can see that this market rose up higher and higher, and so there was probably temptations right here. Okay, I'm just going to give you that point of view here. Is right here there was temptations to get in as a buy. Sorry about that. Let's see here. I'm going to probably close that out. So here we got people rising this up, and we can see that they placed a buy, and just imagine, I mean, you would have gone down quite a bit very quickly. Okay, and that's kind of the thing about trading is your point of view. Okay, if you got in right there, you would have been really frustrated. You thought it was going to keep on going upwards, but that's the thing about the bigger time frames is it helps eliminate some of that frustration. Okay, and what I mean by that is you have a bigger point of views. You have a lot more data to work with in order for you to project in a longer term perspective. You have a lot more information to know where the market is projecting to go. Okay, so looking at this standpoint here with candlesticks, it kind of shows you volume. It shows you the ideas of body languages. Okay, if we look at the bodies of these candlesticks, look at this situation right here. You can see that it's kind of a consolidated type of market, right? Okay, you can see it just consolidate, 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 and it breaks upwards. And then a lot of volume. This is probably during the London and the U.S. session where a lot of volume just kicks in. You can see it's just a big move upwards. Okay, so a couple things you can look at candlesticks. Kind of shows you the activity that's involved within just a certain time frame. Okay, so there was just not that much activity, not that much going on as far as excitement goes, and then all of a sudden it just breaks upwards pretty heavily. The next thing is, okay, the bodies. Okay, so you and the buys and closes. So there's opening prices, and opening prices they just wick up and wick down. Okay, so looking at these wicks kind of gives you an idea that it's rejecting a price. So you can see how it just kicks and pushes the opposite direction. Just because there is a wick doesn't mean it has to go the upward swing, but these wicks kind of show you rejection points and kind of like a kick off the market. So looking at a red candlestick right here, a bearish candlestick, it's basically saying that this market rose up to this high, came all the way back down, and closed as a bear candle, and that was, in this case scenario, was a signal to sell off and trade downwards. Okay, here was a pin bar where the market rose all the way down, or pulled downwards, pushed all the way up, closed on the hour, and closed as a bull candle there, and that was the entry point right there, having a stop loss possibly behind the wick low, and you can see this market rise up towards this area here. Okay, so that's really important. As you can see, these opening and closing prices as well can say a lot of things. Okay, you can see that the market, you see these closing prices here on the left-hand side. Okay, see how it closed, 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 and then it broke downwards. Obviously, that shows you some information that the market really is struggling in this area. Okay, and it comes back up and hits that resistance level, and that's the main thing is you can see the market come up and kick off of it. So that's the thing about this market. You can see that the market has these behaviors of closing and opening prices. So if you look at these this is right here when it came back up, hit this area here. Press. Okay, so you guys can see the screen now. Okay. Let's kind of cover that again. I'm going to kind of cover these things again, just to help you understand this concept, because it's so important. Okay, so let's actually come back to the very basics. Some of you kind of joined in late, so I'm going to go ahead and kind of do a summary of what we just discussed. So like I said before, the history behind candlesticks is very important. You have to realize that it was discovered by Mr. Homo. It was a Japanese individual in the 1800s. So if it was actually used to count rice, or now it's used in the financial markets, but it's been used since 1800s and it's being used now, it's probably going to be used later in the future. Okay, and what I mean by this is such an important principle about candlesticks is that they've been used so long. Why would someone use it if it doesn't work? Right? It's almost like a language itself. So if you understand candlesticks, it's pretty much a body language to tell the trader what's going on in the financial markets. So I just want to kind of walk you through the idea of like volume, and also kind of like the activity a candlestick does for you. So we're actually in 12 minutes in the hour, and this is the activity that's actually happened within the 12 minutes. This is actually what happened, and it came all the way up and came back down and closed as a bull candle. Okay, so this is just 1 hour data, 1 hour data, 1 hour data. So this actually just happened within the day. Okay, so I'm just going to walk you through this really quickly again, is that if you look at this situation here, okay, this is just 1 hour of data. So in about 45 minutes from now, this candlestick will close as, it could be a bear candle or a bull candle. Okay, but if we go to the day chart, what we're doing is we're actually taking 24 of these candlesticks to come up with just this one bar. Okay, this is just one bar, which this candlestick hasn't closed yet. It will be about 8 hours from now. Okay, but this is what happened with yesterday, the day before, the other trading day, and so on and so forth. This is what's been happening in that week. Okay, so as the day chart is concerned, it gives you a huge point of view of the market, of where the market's really going. Okay, so right here, you see that several weeks ago that it was an obvious downtrend here. If we go back to the 1 hour chart, basically, again, we're breaking down that one-day candle into 24 of these sections. Okay, so the point of view is definitely different. And you can see that, what we're interested as traders is we want to look for areas where we can have low drawdown and look for opportunities. In this case scenario, we're looking for these valleys. Okay, if it's on a uptrend, we're looking to buy the valleys and have a stop loss right around this general facility and look to benefit from this rise. Okay, buy the valleys, look for the rise here. So actually pull this back, and I'm just going to walk you through the downtrend that happened just within several weeks ago. So more interested of selling these peaks. Okay, here peaks up, we want to sell off there. Here peaks up, we want to sell off there. Okay, so that's kind of the idea between uptrend, downtrend, and basically benefiting from these market movements. Now, if we take this one candlestick right here on the H1 chart and we go to the 1 minute chart, what we're doing is we're taking that one candle and we're breaking it down about, basically 60 times, guys. So 60 times, or 60 minutes equals 1 hour. Okay, so 60 minutes equals 1 hour, and I'm just going to show you the point of view that scalpers look at. So I'm going to go to the 1 minute chart. Okay, let's actually kick this back forward. This is your point of view. And that means that your decision-making abilities is a lot less. Okay, you have not that much data to work with, and basically you have to consider spreads and things of that nature. But you're pretty much taking 60 of these candlesticks right here is equaling just this one bar. Okay, so you can see the point of view on a small time frame can be very limited. Those are people that want to just get in and out of the market really quickly, but they don't really have to. They don't understand the overhead of a spread that could actually hurt them. Okay, so your point of view here, and I'm just showing you this long wick here, just knowing that this situation could hurt you. So wicked all the way to this top here. We're going to analyze this just this one candlestick this bull candle right here and just kind of show you, you know, the pros and cons as far as the actual small candles or the smaller time frames are concerned. So let's go back to the 1 minute chart. Okay, so you have to think in a hindsight perspective. This is where the general area where that spike went up. Okay, it went all the way to the top, but this is the 1 minute chart, so it's very quick. Okay, so riz, and if you were in this market, basically you would have to react very quickly, and some people that were looking at a chart at the wrong time, they might have thought, okay, that is a really bull market, I'm going to get in. They don't want to miss out. That's just the mentality that goes on. Okay, and then look at what the market did, you know, depending on your stop loss rules and things of that nature, and you can see that it goes against you really quickly. Okay, and some scalpers, they traded really heavy, so that might have been a really bad situation. Okay, the benefit of smaller time frames is if you are really good at analyzing the market and understanding the candlestick patterns and the volume levels, then really you could actually get in at a very precise entry and having a very tight stop loss and to take profit ratio depending on your methodology. Okay, so just to give you an idea, again, like I said, if we go to the bigger time frame, okay, this long wick could have benefited some people, and it could have been a very terrible day for them. Okay, so what I'm saying is I like the bigger time frames just because it's slower, it's easier to analyze, and my reaction time, I don't have to be hugging my charts all the time. Okay, that's just the benefit I look at as far as the bigger time frames. So let's look at the bodies. Okay, so this is a body language. Okay, this is a specific way to look at the markets. Let's actually look at opening and closing prices. See at these dojis right here, they're called dojis because they indecisive candlesticks right here. Okay, look at those closing prices. See how it just ding ding, and then they have a pin bar, a downward pressure candle, and it punches through, right? So it punches through, closes down that way, and comes down in this general area. And we start seeing bold movements. Look how the market comes back up to that closing area and dings off of that. Now once it comes to this resistance area, you can see this candlestick. See how it's a bear candle. It's rejecting this price here. This would be an interesting candlestick, either the close of this candle, stop loss above this swing high, and either a retest. You can see this market pull back up and then kick off about 40 to 60% of this area here, and it drops off. Okay, it drops back down towards these opening and closing prices down here. Okay, I'll just show you again right here. So there's opening and closing prices right around there, and as you can see, it just sit right there. Okay, and then here it just starts picking up, and then it goes back up to resistance. So these candlesticks really do mean a lot of things if you really understand how to translate it and know how to trade them. Okay, so they mean a lot. Not every single candlestick, but I'm just saying general areas of support resistance, and they're just market behaviors. Just because there's downward wicks doesn't mean the market has to go downwards. You can see here there was downwards wick, but then all of a sudden the market just went in a very bullish move. Okay, they're just signs of these candlesticks that in these areas that can help you, give you hints. It's almost like you know, someone trying to wave you down saying, hey, I need help, or basically just a sign, right? We use body language every single day. So it's the body language of the market. Now I want to give you an example here, guys, as far as the Aussie dollar, okay, which is really interesting. If you look at this marketplace here, okay, you see this big move downwards. Really, this big move downwards, if we go to the monthly chart, is just one big candle. Okay, so a trend really is on a monthly candle just one big bar. Okay, so if we look at this on a 1 hour standpoint, you'll see Fibonacci, which is the 50% mark, is a very powerful method. Let's actually look at the concept here. Let's see if we can find it. So Fibonacci, take from the top of a run to the bottom. Let's actually change this. And this is kind of the 50% concept, or they call it the golden zone. Okay, I'm going to change this so you can see the color here. And just understanding the candlestick itself. Okay, so think about just one big run is one big bar on the bigger time frame. Okay, so just imagine this area here is one big time frame, or one big bar on the other time frames. I'm actually going to go from bottom top like this. Oh, actually wrong way. Let's see here. So once you have a big run like this, typically what happens is the market may retrace, and they call it the golden zone because this is an area of support and resistance. Okay, so you got the 50 to 61.8. In this general area, the market tends to reject it. Okay, it's a deciding point. It's also a retest. And you can see it all day long with certain market movements. So I should pull this back, and I'm just going to give you an example. So just imagine these runs as like a perspective of these Fibonacci levels. Okay, and it's actually pretty amazing how these numbers, you can see these numbers just affect the market. Okay, you can see it just bounce between these Fibonacci levels. So just think of this one run as one big candle, and typically the 50 and 61.8 level is a deciding point. Okay, it's not going to be the exact price, but you can see here how it shuffles. So it shuffles, 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 shuffle, and then you have a break of this neckline right here. See that? That was a great opportunity to sell off back down to support, because you have to think it in a hindsight perspective like this. Okay, that hasn't happened yet. So you'll see these Fibonacci's. That's why Fibonacci is such a powerful concept, because it deals with kind of like an equilibrium kind of thing. So you have a 61.8 and 50 zone is typically really strong support and resistance. Let's actually talk about candlestick patterns. Now, candlestick patterns are not just one candlestick. Okay, we're actually talking about a group of candlesticks. So it's almost like not just a one signal, but you have multiple candlesticks, and this actually shows you areas that the market may make a decision. Okay, and typically has support and resistance. So you can see here this is obvious support. So when the market rushed down that area here, we had a long tail. Okay, we had somewhat, let's actually zoom in a little closer so you can see that better. Okay, long tail, we have a bull candle right here. The market comes down, and it doesn't surpass this wick. This closing price does not surpass this area. And then here we can see some bull moves, and then we basically close above this little, you can kind of consider this a double bottom. Okay, so it's not just one candlestick, we're talking about a group of candlesticks, okay, on market behaviors. Here we can see after it closes, you can see some buyers coming in, pulling back down, and then you can see it just working its way upwards. Now some people think, okay, because it rushed downwards, it has to go straight up. It does not. It works its way towards that price. Okay, and if you think about it, you could buy these dips. Okay, so same thing is once the market respects that price, you see here on the right hand side, we had some market movements here. So again, the market approaches that general price range. Look at these candlesticks, guys. We can see that we have a bull move. And the market here, okay, so let's really analyze that long wick there so you can get a better perspective of what goes in a trader's mentality here. We have a long tail that looks like it surpasses the wick before that, okay? And if you imagine on an opening and closing scenario that looked like a red candlestick at one point. For some of those that are not patient, and you know patient is definitely a very important concept in trading, this would have been very tempted to sell off, thinking that this market is pushing downwards and thinking that this is just going to be, going to engulf and close and then drop off. Okay, because you have to think in a hindsight perspective, you think that this is going to fall off. But in reality, this market, this would be the interesting candlestick I would be interested in. That would be the bull move as a buy situation after it closes. Okay, keeping the stop loss behind the wick low. This market may have retested, pulled back and retested. And then after that happens, that's the time where you can have some great buying opportunities or protect your position as it goes upwards. But it does actually retest after the close. See how this market comes back down to this low right here? It comes down and kicks off that low, and then it presents the upper swing. Okay, so pretty interesting, right? So you have a close, market comes down, hits support, and continues on the upper swing. Okay, is there any questions? If you have any questions, please insert them into the chat, and then we can kind of cover some questions that you may have. And I just kind of want to show you one more thing here, and then we can, if you need a recording, please contact Sarah, and she can get you a recording of this webinar. Just please enter those questions if you have any. The actual concept, so there's different patterns that you should learn. Number one is there's candlestick patterns as far as reversals of support and resistance, and then continuation patterns. Now, a continuation pattern is basically expecting the market to continue the upward move. So as you can see here in this example, I'm expecting the Aussie yen or Aussie dollar to continue the upward swing for several reasons, and I can just walk you through the mentality I have with this chart. Okay, one of the things I can see in this market with the 1 hour chart is, number one, I have a low and then a higher low. Okay, that's indication for me that we may be trending upwards. Okay, that's an indication. The next thing I notice is from this low, I have a high. Okay, so this is somewhat of an indication that we're creating a low and a high and a low, and I'm expecting a higher low. Okay, so really, in reality, I'm actually interested to see if price will surpass this high. Okay, once it surpasses this high, I can feel very comfortable. If I was swing trading this, I'd probably have my stop loss maybe around this general facility. Again, this is just educational purposes. It's just an example, but we may consolidate. If I'm actually looking for a better entry point, I might look for this market to pull downwards, maybe an engulfing pattern back in the upper swing. Okay, if I want to get the better price. So it hit, here's resistance, broke up, it may come back down and retest in this general facility. Okay, and that's just my point of view on the 1 hour chart. Mainly, this market has came down. If we look at the back end side here, it was trending downwards for quite some time right here. Okay, you can see it trending downwards, and now what I'm looking for is, number one, it's broken a trend line, and my indication of a break of a trend line is this is an indication that this market has broken a trend, that is no longer trending downwards, that I'm expecting it to continue the upward swing. So kind of a next point, if I want to be more precise, an entry point would be generally right around here. Okay, so I'm analyzing this market, saying that this market is possibly going to start to trend upwards, and then expectations are there. Okay, and if I want to be kind of really tedious, this is something that you want to base on experience. Is here, this is more for those that understand multiple time frame analysis. Usually you just want to stick with one, but you can see here, I'm just going to show you that history repeats itself, and I'm going like this because most people don't see this behind them. Okay, most people that analyze the market will only look at just this area here. Okay, so if you're looking at a 1 minute chart, you're not going to see everything back here, right? You're only looking at this one wick. Whereas my point of view here is I'm actually expecting this similar move to happen. Not exactly, but a similar reaction. Okay, and I might look for possibly a target right around this general area. You can see the market come down, bounce off that price. It came down to that same price. It's showing candlestick patterns of rejecting the lower price. So my expectations probably within, I mean, this is a longer term trade, of course, but I'm looking for this market to possibly rise and maybe struggle, and it could go higher, by the way, than this price right here. Okay, this is, here was support, support, support. I'm expecting it to be resistance and struggle in this general area. But if I'm holding on to this position, as you can imagine, and let's say it's about a week or two, really I'm basically, I mean, I have plenty of time to move my stop loss to +1, and also I don't have to think about it as much. So just understanding these candlesticks really will show you a better way of approaching the market. Okay, so you can see right around here, if you want to be more precise, it may be, I mean, if I want to be extremely precise as far as entry and exit, I would believe it to be right around this area here. Okay, and that's more through experience than anything. So, candlesticks, like I said, they've been used since the 1800s. That should say a lot, okay? And I think that if it's been used that long, and if people are still using it today, there should be a reason why they're using it today. If it didn't work, then they probably wouldn't use it, right? So that's a little bit about candlesticks. If you have any other questions, please plug them in. We have a few minutes there, and then we can wrap this up. Okay, we actually don't have any questions, but like I said, if you do have any questions, feel free to contact Orbex and their staff. They'll be more than willing to help you out there, and hopefully we can see you to the next webinar. All right, guys, have a wonderful day. Take care.